When it comes to diversifying your portfolio beyond domestic borders, the United States stock market often stands out as one of the most compelling destinations. It is home to some of the world's largest companies, most liquid capital markets, and has a broad range of industries that set global trends. But for many investors, especially those based outside the US, the idea of picking individual American stocks can feel daunting. You're dealing with unfamiliar companies, market cycles that may not align with your home economy, and the challenge of separating true market leaders from overhyped names. That is where exchange traded funds or ETFs offer a distinct advantage. An ETF is essentially a professionally curated basket of stocks, often built around a specific theme, sector, or an index. By investing in a single ETF, you gain exposure to dozens, sometimes hundreds of companies, reducing the risk that comes with betting on just one. For international investors, ETFs makes US market participation both accessible and efficient. You don't have to track quarterly earnings for dozens of companies or worry about the intricacies of corporate governance in a foreign market. The ETF structure does that work for you. And another good thing with all these ETFs is that the expense ratio is extremely low compared to Indian mutual funds. But here's the nuance. Not all ETFs are created equal. Over the last decade, certain themes and sectors in the US have massively outperformed others, and within each category, a few funds have consistently delivered market-leading returns. The goal isn't just to chase past performance, but to understand which areas of the market have created the most value over time and why. That perspective can offer insights into long-term trends, sectoral strengths, and the role of innovation in shaping returns. In this video, we'll explore the 5 best performing US-listed ETFs of the past 10 years, each from a different sector. This isn't a list skewed to one booming industry, it's a cross-section of America's economic strengths, from cutting-edge technology to resilient healthcare, from the engines of global finance to the companies driving consumer demand. By the end, you will have a clear view of which parts of the US markets have truly led the way and what that says about the decade's economic story. So here are the 5 best performing US ETFs from various sectors in the last 10 years. Number 1. iShares MSCI Global Gold Miners ETF called RIG. No asset has symbolized wealth preservation over centuries quite like gold. In times of uncertainty, investors have always turned to the yellow metal, and the iShares MSCI Global Gold Miners ETF provides one of the most efficient ways to gain leveraged exposure to the gold mining sector. Launched to track the MSCI ACWI Select Gold Miners Investable Market Index, RING gives concentrated exposure to some of the world's largest gold mining companies that sit at the heart of the global gold production. Unlike holding physical gold, RING invests in the miners, the companies which are responsible for extracting and refining the metal. This structure provides amplified upside when gold prices rise, making it an attractive option for investors who want more than just passive exposure to the commodity. Coming to its performance over the past 10 years, from 2015 to 2025, RING achieved a 10-year compounded annual growth rate of 18.7%, translating into a cumulative price appreciation of nearly 450%. This performance significantly outpaced broader commodity indices and established RING as one of the best performing gold-focused ETFs globally. With an expense ratio of 0.39%, it provides cost-effective access to an otherwise capital-intensive sector. Now let's discuss the drivers behind the performance of this ETF. Definitely the number one is the surging gold prices. Driven by economic uncertainties, central bank buying more of them, and currency debasement, global gold prices hitting record highs, directly benefiting the gold miners. Second is the operational efficiency. Top miners have improved margins via cost optimization, which has expanded their profitability even when the gold prices were stable. Next is the inflation-based hedge demand. Investors sought gold as the safe haven against the rising inflation and the currency depreciation, boosting flows into RING. Another one is the emerging market consumption. Rising demand from markets like India and China, the largest gold consumers, further accelerated growth across mining revenues. Now let's talk about its notable holdings. RING's top positions include Newmont Corporation, Barrick Gold, Franco-Nevada, Angkor Eagle Mines, and Wheaton Precious Metals. Collectively, these companies dominate global gold production and drive the ETF's performance really high. With a 10-year CAGR of 18.7%, RING represents a high-conviction play on the global gold miners and offering an effective hedge during economic volatility. Now, the next ETF on the list is the Invesco Aerospace and Defense ETF (PPA). Few sectors have been seen as strategically important over the last decade as aerospace and defense. The Invesco Aerospace and Defense ETF taps directly into this critical industry, providing targeted exposure to companies powering military innovation, global security, and advanced aviation technology. Tracking the S&P Aerospace and Defense Select Industry Index, the fund includes leading contractors and manufacturers serving governments, militaries, and commercial aviation worldwide. Unlike broader industrial ETFs, this fund concentrates on high-demand defense contractors and cutting-edge aerospace innovators, creating a portfolio designed to benefit from the rising global security needs. Now, its performance over 10 years. From 2015 to 2025, the ETF delivered a 10-year CAGR of 17.47%, amounting to nearly 400% cumulative returns. For a highly specialized sector, this is remarkable growth driven by escalating defense spending and the rapid evolution of the next-gen military technologies. With an expense ratio of 0.57%, it provides efficient access to a highly restricted but thriving industry. Now, what are the drivers behind the performance? One, which is very obvious, is the defense budget expansion. Governments, particularly the United States, has increased their annual defense spending to record levels, fueling contractor revenues. Number two, which is unfortunate, but the geopolitical tensions. Conflicts and security concerns globally created heightened demand for aerospace and defense technologies. Number three is the innovation in aviation and drones. Investments in unmanned aerial vehicles, hypersonic weapons, and advanced fighter jets boosted industry's growth. Fourth is the commercial aviation recovery. Post-pandemic, rising passenger volumes benefited aerospace manufacturers like Boeing and Airbus, supporting broader ETF gains. Now let's talk about the notable holdings in this ETF. Now, top positions include the legendary Lockheed Martin, Northrop Grumman, Raytheon Technologies, Boeing, and General Dynamics. These defense leaders dominate US government contracts and are deeply integrated into allied defense systems worldwide. With a 10-year CAGR of 17.47%, the Invesco Aerospace and Defense ETF offers a targeted play on military innovation, defense spending, and long-term security trends shaping the 21st century. Now let's move on to our third ETF, which is the Vanguard Russell 1000 Growth Index ETF, VONG. The US economy's largest growth companies have shaped the past decade, and the Vanguard Russell 1000 Growth ETF offers direct access to these markets. Tracking the Russell 1000 Growth Index, this ETF focuses on large-cap US companies with strong earnings potential, innovative products, and high reinvestment rates. VONG stands out as for its lowest structure and diversified exposure to companies driving America's digital transformation, consumer expansion, and technological revolution. Now let's talk about its performance over the last 10 years. From 2015 to 2025, VONG generated a 10-year CAGR of 18%, delivering nearly 450% cumulative returns for investors. With an expense ratio of just 0.07%, it remains one of the most cost-efficient growth ETFs available, making it specially attractive for long-term compounding strategies. Its drivers behind the performance have been the tech giants' dominance. Companies like Apple, Microsoft, Amazon, and Nvidia drove sustained revenue and profit growth. Rise of cloud and AI. Structural trends in cloud computing, AI, and data analytics fueled outsized earnings across the tech-heavy holdings. Next is the consumer spending growth. High-income consumer brands definitely benefited from strong US purchasing power, boosting the top-line growth. Next is the ultra-low cost. Vanguard's focus on expense minimization ensures higher net returns for investors. Now let's talk about its notable holdings. Top holdings include Apple, Microsoft, Amazon, Nvidia, Alphabet, Tesla, and Meta platforms. Together, they represent the core growth engine of the US stock market. With a 10-year CAGR of over 18% and a rock bottom of a 0.07% expense ratio, this ETF offers investors a balanced, low-cost pathway to participate in America's most dynamic growth stories. Now let's move to our fourth ETF, which is iShares US Technology ETF, IYW. The last decade has been defined by a technology supercycle, and the iShares US Technology ETF has been at the forefront of this transformation. By tracking the Russell 1000 Technology RIC 22.5 by 45 capped index, this provides a pure-play exposure to the leading innovators shaping the digital economy, from cloud computing and AI to semiconductors and cybersecurity. Unlike diversified equity funds, this ETF delivers a focused exposure to the US technology leaders, making it a powerful vehicle for investors seeking growth in the tech megatrend. Performance over 10 years from 2015 to 25, it has been able to deliver a 10-year CAGR of 22.32%, translating into a 650% cumulative price appreciation, one of the strongest performances among all US-listed ETFs. With an expense ratio of 0.39%, it provides direct access to a sector that has consistently outperformed the broader market. Now, drivers behind the performance. AI and cloud explosion. AIYW's largest holdings benefited from rapid adoption of AI-driven technologies, cloud platforms, and SaaS business models. Next would be the smartphone and digital ecosystem growth. Companies powering mobile computing saw unprecedented scale globally, driving recurring revenues. Semiconductor dominance. Tech hardware and chip makers like Nvidia and TSMC capitalized on soaring demand for processing power. Platform-based monopolies. Leaders like Apple, Microsoft, and Alphabet leveraged network effects to strengthen their competitive moats. Notable holdings are the expected ones, which include the Apple, Microsoft, Nvidia, Alphabet, Meta, Broadcom, and Adobe. These companies dominate global innovation and remain the largest value creators of the past decade. With a 10-year CAGR of 22.32%, this particular ETF is a high-growth vehicle for investors looking to participate in the next wave of technological disruption. Now comes the last in the list, which is the VONG Semiconductor ETF. No sector has defined the last decade quite like semiconductors. Chips are the brains behind the modern technology, whether it is smartphones, whether it is cloud computing, electric vehicles, and most recently, the explosive rise of artificial intelligence. The VONG Semiconductor ETF has been the purest play on this global megatrend, launched in 2011. SMH tracks the MVIS US listed Semiconductor 25 index, giving concentrated exposure to 25 of the world's leading semiconductor companies. Unlike broad technology ETFs, SMH is highly focused, with a market cap weighted approach that places more weight on the industry's biggest winners. This structure has been critical because of the handful of semiconductor companies, most notably Nvidia, have delivered extraordinary gains that lifted the entire sector. Performance over 10 years. From 2015 to 2025, SMH achieved a 10-year compounded annual growth rate of 30.86%. That equates to a staggering 1200% cumulative price appreciation over the decade, far surpassing the broader market and every other ETF in our lineup. Simply put, SMH has been the best performing US listed equity ETF for the past 10 years. The expense ratio is merely 0.35% for this. Now, the drivers behind the performance. Several forces propelled SMH's outsized returns. Nvidia's crazy dominance, once known for gaming graphics, Nvidia transformed into an undisputed leader in AI chips and data center GPUs. Its meteoric stock rise has been the single biggest contributor to SMH's performance. Global chip demand. From iPhones to cloud computing, semiconductors became essential across industries. Demand spikes from consumer electronics, 5G rollouts, and EVs all boosted these chip makers. Geopolitical importance. The semiconductor supply chain became a strategic asset, drawing government investment and support, particularly in the US and the Asia. Diversification within chips. While Nvidia stole the spotlight, other holdings like Taiwan Semiconductor, Broadcom, AMD, and Qualcomm also delivered strong growth. Equipment makers such as ASML and Applied Materials benefited from the industry's capital investment cycle. Now, coming to the notable holdings, SMH's top positions include Nvidia, Taiwan Semiconductor, Broadcom, Qualcomm, Intel, AMD, and Applied Materials. These names collectively represent the heart of the global semiconductor ecosystem, from design to fabrication to equipment. With a 30% annualized return over 10 years, SMH stands as the decade's ultimate growth story. It not only highlights the importance of semiconductors in shaping the modern world, but also shows how concentrated exposure to an essential high-growth industry can deliver market-defining returns. So that's it, guys. That were our top 5 ETFs pick that you can surely consider while investing in the US markets. And if you want to do so, surely try out the Appreciate app, where you get hassle-free access to the US stock market without any worries. Thank you so much.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.